Hello, everyone. Welcome to the Nest Egg Builder Show. Today, Peggy is at a REN conference today in Phoenix. So exciting! I love my REN organization, but I stayed back here in California. But we also have another REN member, and also she's a national sponsor of REN. It's Caeli Ridge. She is a second generation mortgage lender, very knowledgeable about all things related to loans and money. And she's a big proponent, as we all are within the REN organization, to provide financial education as she's giving her services. So we're very excited to have her, and I will turn it over to Caeli Ridge now. She'll be talking about our interest rates and a little bit touch on what's happening with the banks. Thank you.
Thanks, Nika. Hi, everybody. Thanks for having me. Good afternoon, or maybe later for those of you that are, I don't know, maybe not on, I'm on Pacific time. Good to see you all. So Nika and her group was gracious enough. I saw them, is it maybe a week or two ago, during a REN event, a virtual REN event, and they were gracious enough to invite me here with you today and kind of share some insights about what's going on in the weeds of the background of the financing end of real estate investing. Just as a quick FYI on who we are, some background about me and the company. Nika mentioned we're a second generation company. We're licensed in 47 states. We're not in North Dakota, New York, or Vermont. Otherwise, we've got a very broad footprint anywhere that you want to be looking to buy or refi, sell, whatever. We are not a one-size-fits-all gang. We have a very diverse menu, if you will, of loan products, much of which is dedicated to real estate investors. So you've got the agency Fannie Freddie. We have commercial products, non-recourse, recourse. We've got non-QM, debt service coverage ratio, the all-in-one, which is my personal favorite, on and on and on. So we have lots and lots to choose from. And I think that what I would want to share with you in closing of this long-winded resume is that I'm a fellow real estate investor. I've held many properties all over the US, so I kind of have a unique lens as well, and I hopefully will be able to share some of that experience and having the hat on from an underwriting and lending leverage perspective. So my bullet points, I'm just going to get right into this, and I think there's going to be Q&A, right, Nika, at the end, or that you guys will have. Okay, so you guys have an opportunity to ask.
Yes, we have it at the end. Yes.
Okay, perfect. So obviously, whatever you guys have at the end. First topic: how the closing of banks affects the lenders and their borrowing capacity. People seem to be in panic due to the lack of information, which is 100% true. I think that that's true for anything. Lack of information leads to misunderstandings, some bigger or smaller. So everybody's heard or seen the headline at this point of the Silicon Valley Bank, right? Kaput, gone. There's been, at least to my count, and I haven't checked as of this morning, there were two others that followed suit directly afterwards. So people can be panicky. And what happened, it's called a bank runoff. So people get freaked out, the regional banks, probably close to where Silicon was, and they go in and they take all their money out, right? They're scared to death. They don't want to lose everything. So they go in and they take all their money. The stocks are selling, whatever. The banks need that depository to keep going. So, hindsight, maybe there should have been a little bit more discussion, or maybe there should have been more out there for the public to understand what the bottom line reasoning was for Silicon's failure. And we can get into any of that if anybody's interested. But where we are right now and how it affects your ability to qualify and or secure leverage other people's money to get that greatest rate of return, right? Because without it, our rate of return is diminished greatly, is very, very little. There's not going to be too much impact from that to what we are offering here. Depending on your qualifications, of course, I mean, there could be some guideline changes and such as a result of what we're finding, but I'm not really seeing too much in the way of tightening of the purse strings. All of the same products that we had a week ago, 2 weeks ago, whatever, are still available now. I've got no notification or indication that any of that's going to change. What I will tell you is that we want to be paying attention to, if you haven't been, or if you don't, you should be listening to what the Fed is saying. They have been extremely clear over the last 14, 16 months. Well, even prior to that, but starting in 2020 or late 2021, starting in 2022, the Feds have been extremely clear about what the trajectory is and exactly what they're going to be doing. And they've made good on it, right? They said what they were going to do and they kept doing it. And I feel like in lending, especially, People are overly optimistic sometimes, and maybe they expect a different result, even though the Feds have said this is what we're going to do. We're going to raise interest rates. We're going to raise interest rates until we get inflation down to 2%. Okay, we're at 6 right now. We have a nice margin left to go. I think we started at 9 something, so we're not even halfway there. So are they going to continue to raise interest rates? I think 100% yes. How they're going to continue to raise interest rates is to be seen. So they're meeting today and tomorrow. Anybody that kind of pays attention to that, Mr. Jerome Powell, who is the Fed chair, will be announcing tomorrow what happens with the Fed fund rate, if they're going to be raising it or not. And they find themselves in a very impossible position, you guys, because if they don't raise rates, inflation continues to stay what they believe to be out of control. The cost of goods are going to remain high. Housing prices are not going to start coming back down where they want them to be if they don't raise rates. So we can't have it both ways. If they do raise rates, then we could have more banking issues. And the perception of that, I think, might keep them from either raising at all or maybe raising to the level that they would have otherwise. If you would have asked me 2 weeks ago, are the Feds going to raise on March 21st? I would have said without hesitation, yeah, absolutely yes. Okay, prior to knowing, what happened with Silicon. Now that that's happened, are they going to raise rates tomorrow? I think my prediction, okay, we'll see tomorrow. I think they're going to, but I think that maybe they only raise it by a quarter point versus maybe a half or 3/4 that they may have. Now, how that parlays into interest rates that we're talking about, and just really quickly for anybody that doesn't know, the Fed fund rate is the daily intra-changing rate that is paid between banks. That if banks are going to be trading money back and forth, that's what that interest rate is. The long-term mortgage rates that we are interested in having to do with our mortgages that we get for 30-year fixed or whatever it is, completely different, two totally different things. Now, while there's a connection, they are very, very different. Secondary has already started to prepare. I don't think whatever the Fed says tomorrow, other than maybe just a few hour knee jerk, we're going to see too much difference to the rate as a result of that, what we would be locking on for our mortgage rates. But bigger picture, I would anticipate, guys, interest rates are probably going to be on the rise for the remainder of the year. If I can, I don't want to beat a dead horse, but I want to take this just another step further because it's a hot topic. Top of mind for most people are where are interest rates going? And I feel like that there is a psychology to the interest rates that need to be dispelled a little bit. As investors, right, we have to prepare and set the right expectation. Real estate is cyclical. I think of all the investments out there, it's probably one of the more cyclical investments. And as a result, the returns that we were getting back in 2020, 2021 are different now. Rates are higher. Of course, they're different. So we have to set a new expectation. But as that relates to interest rates, depending on the loan size largely, but if we're talking about $100,000, $150,000, $250,000 mortgage, the difference in your principal and interest payment for a 6% interest rate versus a 7% interest rate might only be $30 a month. Maybe it's $50 a month. It's not as that psychology. When I hear 6% versus 7% or whatever the spread is, that garners a certain image. But when I do the math and I look at it in black and white, it's not nearly as relevant as I think a lot of us give it credit for. And then, of course, we've got appreciation of rents on an ongoing basis. So keeping that in mind, just do the math, I think, is really the point that I'm trying to make with interest rates as they're on the rise. Do the math, make sure that you're not just saying, oh, rates are too high, I can't qualify, or the property's not going to work for me right now. Any comment? Are we going to wait for comments, questions? Should I just go on to the next, Nika? The next bullet I have here.
Go ahead.
Okay.
If anybody does have a question, you can start putting it in the chat and then we'll get to it at the end.
Okay. Actually, I think I just touched on this, but the next one is how are interest rates affecting investors right now? Newer investors, I think, are more impacted because they don't have the information. So I would say that because they're new to this and they don't realize or recognize that a long-term rental of $100,000 might be more impacted at a 7% interest rate in Alabama than a 2 to 4 unit that one half is short term and one half is midterm, right? So I would say that those that are being affected through interest rate are going to be newer investors. And for you, if you're on this call here today, I would encourage you to look at diversifying your portfolio, right? Not looking at it from one lens or one angle. if today's interest rate doesn't work for that particular class of investment, real estate investment, then look at something that is a duplex, triplex, fourplex. Look for a midterm or a short term to offset a little bit, or maybe look in a market where you can still find. I mean, every market's going to be unique, right? Not all single family residences are going to have the same impact on a long-term rental. Some states have much lower taxes and still have really strong rental pools, et cetera. So,
or passive investments.
Yeah, right. Maybe mortgage notes or syndications or whatever. I mean, Nika and her team I'm sure have all kinds of alternatives to the one investment in real estate, right? That one thing that is going to be mostly impacted at a 7% interest rate. And even if it is, I'm still seeing cash flow. So I get to see, in 47 states, I get all the appraisals, I get all the leases, I get to see it, and I can see kind of that average, the averages that are coming out. And what I would say is that I still haven't seen negatives. They're not negative. Now they're a lot less in the monthly cash flow than they were, but you're still cash flowing $100, $150, $250 a month. Okay, you still have tax incentive, you still have appreciation if it's in the right market. These are longer term investments anyway. So setting that new expectation, I think I would come back to that in closing the loop on that question. Yeah, and then general thoughts on recent bank closings. I think that the Fed, we got to pay attention to what the Fed is going to say tomorrow. So, maybe Google Fed meetings, and you can get on, and the minutes will be available as soon as they're released, and you can kind of read through. It's like stereo instructions, but you can read through what they have to say and see what the projection is for the coming weeks and months.
Excellent, thank you.
You bet.
Does anybody have a question? Is it that time? That seemed like a closing.
I did, yeah. I got through each of the bullets that I had here. So, yep, I'm ready for any questions that anybody has.
Okay. Well, someone asked what the name of your company was. I did answer it, but you could go ahead and say that again. She's based out of Oregon.
Portland, Oregon is our corporate offices. Ridge Lending Group. Yeah, I'll give you guys. You want me to put in the chat here, Nika, just the phone number and website? Is that all right?
Sure.
Okay. 855-74 Ridge is the toll free, guys, if anybody wants to call us. And then the website's just ridgelendinggroup.com. There it is. Come on, somebody's got to have a question.
Right.
How about I'll ask some questions. Who's what? So Nika, maybe tell me your guys' profile. What you guys really are sought after for? Is it more passive?
Yes, it's all passive and all commercial. So
all commercial. So 5 units and above, storage.
Right. So multifamily, industrial, storage, development, notes. We have one that's like a note. What else, Cliff, do we have? Oh, shopping center. We'd like to get an assisted living. What else? There was an RV park, but that went away.
We had assisted living. It just closed out. Well, no, actually it's drug rehab.
Oh yeah, drug rehab. That was my favorite. That was a good one.
Yeah.
That was a good one.
Yeah. So multi-unit, Nika, so above 4 units or 2 to 4 and above?
No, above 4. It's all more big syndications. So what passive investors would be into.
Yeah. Gotcha. And in fairness, guys, I was kind of leaning toward the residential side in terms of what I was sharing. On the commercial side, I think that it's going to follow suit rate-wise. It's all kind of interconnected. So there'll be a difference between what you're seeing in cost of funds here in the coming weeks, months. I would say if I had to predict, my crystal ball has been broken the last couple of years, but rates will start coming down sometime. Let's hope for this time next year, if I had to guess. Let's say spring-ish of 2024 when we start to see anything significant in rates coming down.
Well, I think one thing with that that we're finding that's helping to offset it is that the sellers are starting to realize that they have to bring down their price. So it ends up balancing itself out in that sense too.
100%. Yeah. When I talk about that a lot, Nika, a lot of times the pushback is people say, well, not in my market. And then my response is that your market's coming too. I fully believe that every market is going to feel a pinch in some way or another where those price points are going to start coming down. That's what the Fed is trying to do, and they're not going to stop.
Yeah.
One of the primary markers here is housing. So they're going to keep raising those rates until home values come back down. So I believe everybody is going to see this in some fashion, form or fashion. So yeah, the higher interest rates should be offset at least in some way by the lower price point. Still do the math. But the other thing too, and you guys have probably already talked about this, is that in addition to negotiating price points, you should be negotiating seller paid closing costs, right? Having the seller credit back a few percentage points of the purchase price to maybe buy the rate down if you want to. I don't know if that's going to be to your advantage or not, especially since most of you are probably going to be refinancing in a couple of years when rates come back down. So who knows, but yeah, that would be another way to kind of squeeze out some more juice, is get the seller to contribute towards the closing costs.
Yeah, I have a
So
question too. Is there a way to lock in an interest rate? Like, I know people were doing that before because they knew that things were going to come up and they were paying to lock it in at the floor, knowing that things were about to go up, that the interest rates. I know a few of my investor friends did that.
Yeah, so we can lock in 90 days in advance on most products. Not all, but most products we can lock 90 days in advance. Beyond that, I think that you'll find most lenders are unwilling to go longer than 3 months in a lock. And in fairness, guys, you probably aren't, it's not probably to your advantage to do that anyway. I think that the secondary markets are going to be so volatile that I think that if you do that, you could be shooting yourself in the foot. Because the only time, once you lock, you're locked. You can't have it both ways. Once you lock, you're protected. If rates come down, you're stuck at that rate. The only way to get the new rate is to let it expire for 30 days and then relock.
Yeah.
But you can, yes. And points are tax deductible. So if you decide to buy the rate down a little bit or carry it out, points on rental investment transactions are tax deductible. So
I didn't know that.
There might be some secondary there. Yeah.
Caeli, can you say your phone number again? I can't see the information on the chat.
Sure, 855-74-RIDGE.
Oh, I think what happened is that you direct message.
I did, didn't I? I'm sorry. Yep, let me do it again, guys. Sorry. Copy. Not just Tanika. It only lets me do it to you or
Oh, really? Oh, this
Cliff,
is.
yeah.
Oh,
Try it now. I restrict it whenever you actually go through, so people aren't posting while you're speaking.
There
Got
it
it.
is.
Thanks, Cliff.
Got
Yeah,
it.
yeah.
Cliff's the man. I don't know how to do all that.
Yeah, I think somebody else had a question.
Yeah,
Cliff
I've
has
got a
one.
question.
Okay.
So I'm kind of curious. We saw a lot of record low interest rates in mortgages over the last several years. Just constantly going down, and it really didn't seem to follow what I expected to see in the 10-year Treasury yield. So what I found later was that the Fed was actually purchasing mortgage-backed securities since 2013 in mass, and during COVID actually bumped it up even more. And then last January in 22, they announced that they were going to start selling off the mortgage-backed securities. In March, they announced that they were actually going to stop buying them altogether and continue to sell off. That's when we saw our first spike. They were selling off about $45 billion a month in mortgage-backed securities. And last September, they actually upped that to $95 billion per month in mortgage-backed securities. Again, we saw a spike. So considering that they were buying mortgage-backed securities since 2013, it's hard for me to think that we're going to see low interest rates again anytime in the next 8 to 10 years.
It's a really good point that he's making, guys, and this is heady stuff, right? This gets into some technical stuff. I don't know how far down the rabbit hole you want me to talk on this, Cliff, but what I will tell you is
go in it, because this is a question that we've actually talked about before on our show. Doug Harris has had specific questions on this. I didn't know how to answer this, so this is why I really wanted to send this to you.
Okay. So the Treasury, the 10-year Treasury is a marker for, a lot of people will look at that to try and predict where interest rates, the long-term bonds, our 30-year fixed interest rates are going to go. And it's usually pretty good, usually pretty accurate, but there's so many variables, you guys, way more than I could ever predict for, that can completely derail or change. So if you're going to try and play the market and watch the ticker tape and stuff, by all means, look at the 10-year. just be prepared that anything could derail it. It could be Ukraine. I mean, it could be, there's so many different things that can play a role in removing that as a means of saying that that's going to, like you said, Cliff, that you saw it go up and it came down and the rates were affected differently and et cetera. So the Feds during, and I can't go back to 2013, but I can tell you that when the Feds were purchasing mortgage-backed securities at almost an alarming rate. Now, if they hadn't done that, we would have been in way more trouble than you know, on the housing and lending side during the pandemic. Billions and billions of dollars a week, 40 billion a week. They were buying mortgage-backed securities. Ungodly amounts of money was being purchased on the secondary by the Feds, Fannie and Freddie, et cetera, the agencies. Now, that couldn't have lasted forever. They still are going to be the biggest holder of mortgage-backed securities ever. Even now, they're not going to sell everything off. And in terms of the relation for how that's going to impact the 10-year, I don't know that I can really answer that, but I will tell you that as they continue within the quantitative easing and they start selling off these mortgage-backed securities, the stock market and the investors, based on even more variables that I couldn't account for, are always going to run to the safe harbor or the security of the long-term bond. So even when we see them offloading all of these mortgage-backed securities, I do believe as inflation starts to come down, there are going to be investors that come out of the woodwork that are going to pick that stuff up. I don't think it's going to dictate whether rates, our long-term rates, go up or down as much as you may think, Cliff. In fact, I think that as soon as we start getting inflation under control a little bit, we're going to see them start coming back down. Are they ever going to be?
That? Something drives that. I see there's a 10-year treasury and short-term yield bonds actually have a higher rate than long-term yield right now. So what's really going to, short-term yield bonds have a higher rate than long-term yield bonds today.
Inverted
So
yield.
what's really going to, it's inverted. So what's really going to drive that? Because it really doesn't seem to be conducive for lower rates, which really perplexes me, because yesterday we saw a reduction in rates again. And I'm like, okay, what's really driving this? It doesn't make sense to me.
Well, so let's go back to yesterday. So tell me what you saw, a reduction in rates, because that's not what I saw on my side. So what you may be having,
I saw it drop below 6.
Okay, you're talking about the Treasury again.
No, I'm actually talking about mortgage rates.
Okay.
Yeah, I saw mortgage rates drop below 6, and I'm like, okay, what's driving this?
Yeah. So, okay, I want to add some color. This is going to be a little bit of a rabbit hole, and then I'll get back on track. So when we talk about interest rates, you guys, there's lots of variables that dictate what your individual locked rate will be. Okay. There's something called an LLPA, and Cliff, you may be familiar with this. It's a loan level price adjustment. This is a positive or a negative number that attaches itself to the characteristic of the transaction. So these can be things like loan size, loan to value, property type. Is it a single family residence? Is it a 2 to 4? Is it a condo? Credit score can play a role. Debt to income ratio can now play a role. Is it a purchase? Is it a refi? Is it a cash out? Is it a rate and term? All of these variables have their own unique LLPA. Okay, so when you see 6%, that's probably characteristic of an owner occupied. If I didn't say occupancy, that's another big difference in LLPA. You're probably looking at interest rates having to do with an owner occupied rate and term refinance at 65% or less LTV, right? Maybe that's what the characteristics, the fine print, I don't think is in probably what you're seeing. When I'm looking at interest rates yesterday, they actually went up throughout the day, but I'm looking at the non-owner occupied side of things. So there's a big difference between when you look at the stock market and secondary market, the appetites that they have and what's being posted out for the masses is not necessarily what you guys are going to be securing interest rates or locking interest rates for. So there's going to be a divide there. If it's for that vanilla owner occupied, as safe as bet as it can be, then fine. Okay, so just to kind of quantify that a little bit. Going fast forward, Cliff, your last question was, so what's dictating, right? What will dictate when and if they do come down? Or I'm saying that I think they will come down, and you're saying what's going to dictate that?
Well, I'm thinking that they're going to continue to go up. I think that we're either going to see a flat or go up. And the reason I say that is because we're going to have a lot of mortgage-backed securities that have to be offloaded. And if that's what brought it down, then logic would dictate that's what's going to push it up. And if we can't trust what we're seeing in the 10-year treasury yield, and we're seeing that yield rate inverted from long-term to short-term, then what else would be driving it?
So there's two things that I see as add-ins or possibilities to this. One, the conservatorship of Fannie Freddie. that may be coming to an end. Now, that's a whole nother conversation. It's been on the books, it's been on the talks for a long, long time. COVID actually put a stop to that. And not that I've seen anyway, they haven't really come back to the table with it. So if the conservatorship goes away, which happened in 08, 09, right? Dodd-Frank and all that stuff that was Fannie Freddie was put into conservatorship. If that goes away, then all of the other secondary market mortgage investors are going to have, the playing field is going to be a little bit more leveled. Without that United States insurance backing that mortgage-backed security, and we have all of these other players that are going to be, because nobody can beat Fannie Freddie right now, right? The rate and the cost and everything, nobody can come close to it. That's what non-QM is for. If they come out of conservatorship, like I said, the United States insurance guarantee against default, because if a Fannie Freddie loan defaults, right? If the investor that's holding that mortgage-backed security, if that mortgage defaults, because it's backed by the US government, they're cutting a check. They're going to make you whole. And outside of conservatorship, that's going to go away. So that could be one piece of it. The other piece is, I was just talking, you said, interest rates are high. There's going to be a flood of new mortgages when rates come back down, and the servicing rights, and I think that the feds are going to step back in. So Ridge is a direct lender. Okay, we fund on our warehouse line, we underwrite in-house, but we don't service these loans. So we package them up, right? Mortgage-backed securities in a bundle of 5 million, 10 million, whatever, and we will sell them on the secondary market to what I call an aggregator. Ultimately, it's going to land with a servicer. Okay, so when you guys make your mortgage payment, you send it to PennyMac or Wells or whatever. That's the servicer. So servicers pay a premium for access to those servicing rights. So if they're going to buy $10 million of mortgage-backed securities, let's say they pay 1 basis point, right? They pay a percent for the right to service those loans. Well, we know in the mortgage industry, it takes that servicer about 36 months before they're profitable, right? They pay a premium up front, and it takes about 36 months before they're profitable. Now, if that has been secured in the last 12, let's call it maybe closer to 8, 10 months, as interest rates have continued to kind of go up, 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 when we know that rates, and they don't stay static, Cliff, they're not going to go up and stay up or go down and stay down. I do believe that they're coming back down, but this may tie into what you're saying. If I'm right, and they do, all of those mortgages are going to run off, and those servicers are going to be left in the red before they hit their 36 months. So I think that the feds are going to come back in and probably be purchasing some of those losses, if I had to guess.
With what money? I mean, our deficit is so huge right now in our country.
I don't have that answer.
Yeah, that's going to be a tough one to actually complete. Okay, I'm good with my questions. Thank you.
You're welcome. I don't know that I answered them eloquently, Cliff, but that's my 1.3 cents worth anyway, sir.
Yeah, I think Derek, you have a question?
Yes, I actually agree with everything that you guys are discussing. I think there's just one factor that is being left out, which is the fact of that rates was at such an all-time low that buyers are just being priced out of the market. Because if I own a house at 3% and I want to move into a different home, there's no incentive for me to buy a new house and sell the one that I have. So I just would think that naturally that some banks are afraid because they're not being able to find new business, because it's just the rates, it may not be that high, but it's going to cost that new buyer or that new borrower more money to live regardless. Unless, I mean, an investor, I think it doesn't matter so much. But I'm just looking at the overall, someone's buying a house to live in, they're just, rates were so low that you won't get as many refinances, anything, because there's no incentive. Like what I'm saying is prices are almost, the interest rate will almost have to come back down closer and to where to try to get some of these old deals that were out in the past that were people at 3%. Because I'm telling you, it's the houses I got, there's no way that I would, I wouldn't, I'm locked in for years to come at the rate that I'm.
Well, you make a good point. My comment to that would be a fewfold. One, the interest that you pay on your home is always going to be less than credit card debt, and invariably, people, a lot of people live outside of their means. The credit card debt is always going to be a thing, and I promise you, it'll be hard, but you'll see refinances to pay off consumer debt. It's just going to happen. I'll share a couple statistics, and then I'll come back to adding in some other variables that I think might counter what you're seeing. The percentage, and I think that this will probably be one exception in history so far. What you're saying is how low those rates were. But if you go back before that, the percentage of people that started with a 30-year fixed mortgage and made 360 payments later to pay it off is a fraction of a percent.
I
Okay?
believe it.
The average shelf life for an owner-occupied mortgage is about 7 years right now. We know that for an investment property, it's closer to 5 years. It's usually a little bit shorter. So there's going to be that. But with keeping that 3%, I think that you're right. There's going to be a much larger percentage of people that have that interest rate that actually cross the finish line 30 years later and maybe start looking at HELOCs, right, as a second lien to harvest equity or whatever. But those that ultimately maybe for rental properties, because those are harder to get, HELOCs, home equity, you can get HE loans more easily, but home equity lines of credit and second lien possession on rentals are not as prevalent. I think that they will probably refinance to harvest that equity and then go purchase more investment properties. Borrowed funds are non-taxable. And even though they're losing that 3% rate or 4% rate or whatever, it's really going to be the cost of the equity compared to the gain of the replacements, right? So there's all of those different things that you need to factor in. And then lastly, you got a whole nother subset and generation of people that are going to be buying. Derek, right? You've got the next generation that are going to be buying homes, et cetera. There was the refinance boom that we saw in 2020 and 21 was unprecedented. And I do think you're right. There's going to be a much bigger pool of people that are not willing to part with those interest rates. But I kind of feel like it's not going to be as big as maybe some people think. I think people are going to refinance and get at that equity overall. I think it'll happen for consumer debt or for reinvesting purposes. But it's a good point.
And like we said about the costs are going to come down too for people to buy new. Someone may not leave their old one, but for people that need a home, they need a home, or they may that the cost will come down for that, because there's always what do they say, death, divorce happening, right? Yeah. And like you said, the new generation that's coming in, so.
If
so maybe they keep it
long, then yeah, that'll lead you to new house buying all the time. Sell it.
Yeah, maybe they'll keep that 3% in a way that they turn it into a rental, right? When they that departure residence is kept, and then they get equity through a second and buy their new primary residence at 5, 6, whatever the rate is. Yeah.
Okay. I appreciate it.
Yeah.
Cliff.
Yeah. So I've loved the answers that you've provided so far. I really do. I think you've done a very good job. One thing that I might actually contest just a bit is mortgage interest being the cheapest debt that's out there. I do a lot of work in debt elimination, and I actually look at amortized loans. And when you look at a mortgage that's at 7% for 30 years, you're going to spend 87% per year just in interest. That's higher than any credit card you could ever see. The highest credit card I've ever seen is 36% per year. And then you're still paying that on a 7% loan for 30 years, over 80% for the first 7 years. So I would actually contend that it's not the cheapest debt that's out there. It's just scheduled out differently. All your interest is on the front end of the loan, your principal's on the back end of the loan. So that's the only point I wanted to make there.
I think that's fair. I'll take that. But if we're talking about investment properties, interest is tax deductible, whereas it wouldn't be on a primary residence, which I know that, maybe we're talking about both things there. And 100%, Cliff is 100% right. If you look at a 30-year amortized mortgage, the first 10 years, 99% of your payment is going straight to, they want that interest, man. You're not paying anything on the back end. But like we kind of said a second ago, the percentage of people that are going to keep that mortgage past X, now that bleeds into your point too, Derek, that those low interest rates, who is really going to be getting out of those if they need the cash? So Cliff, my follow-up question for you would be, where are they going to where are they going to harvest? Where are they going to generate cash to pay off higher consumer debt? Where would they go for that if it's not going to be, maybe a rental, maybe it's a primary, whatever? Where's the cheaper place to go for that? Did you say? Maybe I missed it.
So a cheap place to go to actually pay off debt might be a cash value life insurance policy.
Okay.
Having that, you can actually borrow
Life
against that.
insurance.
It grows compound interest. So that's a very inexpensive way to actually pull money and then apply that somewhere else to pay off higher interest. A Roth that you're actually taking distributions from after 59 and a half, it's a tax-free instrument because you're paying all your taxes on the front end. Those are two great ways to actually address that.
Another place to look, and I got to bounce you guys, but the all-in-one, I mentioned that earlier. It's similar to what Cliff was mentioning in the, I believe, whole life insurance policy. It's an arbitrage. It's a little bit different in its interest saved versus earned over here. If anyone's not heard of it, Nika, let me know. I'd be happy to send you an email that has an FAQ and a link to an interactive simulator. The all-in-one is just the best product for most investors. Not everybody. This doesn't work for everybody. If you don't have cash flow, or if your spending habits are such that you have nothing left over at the end of the month, the all-in-one is not going to work for you. But if you have a property that's got lots of equity in it, I have run the simulator where, Derek, to your point, this person's primary residence had a 3.5% interest rate. The all-in-one fully indexed today is 8.7. The all-in-one you pay less interest on. It's a velocity of banking, infinity banking. If anyone's heard of that, that's kind of what Cliff is talking about. Could be a great tool for mitigating interest and offering a huge amount of flexibility. It's a 30-year line of credit, not a 10-year interest only, 20-year repay. You have it for 30 years. So you're not having to go back through and do cash out refinances and the brain damage of going through the loan process, the closing costs, et cetera. The all-in-one mortgage, first lien HELOC might be a good alternative to, or an add to what Cliff is saying.
Can
And
you
you keep
expand on
tapping
that?
it?
Because
Yeah, that's exciting.
yeah, Karen actually put in our chat message, if you can expand on that a little bit more with the all-in-one, exactly how that works, because that sounds really good.
It's amazing. It is my absolute favorite. And you guys, I'm so sorry. If something came up and it's an internal thing with a system that we're using, it actually is our platform for the all-in-one. Disclosures are going out wrong. So I gotta take this, but maybe if you have me back, or I'll send you an email.
Yeah,
okay.
Send us an email, but maybe we'll have you back to tell us about the all-in-one.
Because it's heady stuff. Most people conceptually, it's very, very foreign in this country, especially. I've been in finance for a while, and I feel like I know more than the common, the average bear. I had to look at this damn loan for 2 weeks before the light bulb went off. So it takes longer than I think a few minutes anyway. But yes, I'm going to send an email.
Please come back and
definitely
go over that.
back.
We'd love to hear about that.
And we can even share screen. I can do the simulator while you guys watch, and
that would
we
be
can do the whole
awesome.
thing. Okay, I'll have Carly reach out for that, and then I'll send an email. Okay,
excellent,
thanks you guys for having me.
Thank you so much.
All right, I'll see ya. Bye, guys.
You can end the recording clip.